Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is John Mayer, Chief Investment Officer at Global X, and we'll talk about thematic investing strategies for 2023. So this is third in the series of our 2023 investing guides. We talked to experts from BlackRock and State Street in the first two episodes. Global X, as we know, is a leader in thematic ETF investing. They offer 100 ETF strategies with about $37 billion in assets under management in the US. So we'll talk about John's market outlook as well as his favorite themes for 2023. And in the second part, I'll talk about some ETFs that you could use to implement those ideas. Joining me now is John Mayer. Hi, John. Welcome back. Great to have you on the show.
Thanks, Nina. Thanks for having me on.
So 2022 has been a brutal year for investors, with almost all major asset classes suffering record losses. But thankfully, it is drawing to a close now, and investors can look ahead to 2023. So let's start with your 2023 outlook. What lies ahead for investors in the new year?
Thanks, Nina. And yes, you're on target there. This wasn't the best year in the world. Without recapping the entire year, you saw major indexes down. The Nasdaq's down over 30% at this point. The S&P's down just about 20%. So liquidity was kind of thrown into the market to offset kind of the intentional shutdown of the global economy during the pandemic. So we know that there was a ton of money that went in, and when the world started again, everyone had money from all these different fiscal policies, and also from just not spending. So the consumer was in a really strong position. So demand was so high, and owing to all the wrangled supply chains and problems, we got inflation, and we got inflation in the most unusual way. So you get inflation from credit expansion, but this time we got inflation from supply and demand complexities, to the point where the Fed had to step in. And the Fed was certainly late to the game, so they had to play some catch up. And we call 2022 the year of the Fed. Quite honestly, I think 2023 will also be the year of the Fed as well. And perhaps every year is, in a way, is the year of the Fed. So our friend the Fed will need to find a balance between curbing inflation and weakening the economy too much. And that's kind of the argument that's going on now. So they're trying to engineer a soft landing, but that's really a tough needle to thread. But they're certainly going to make that attempt. I think the market's not hopeful that they can actually accomplish that soft landing. And you see the market react every time the Fed speaks. The Fed says something that may indicate that they may pivot. The market has a positive reaction. We've seen this happen on the upside. We also see this on the downside. But Powell has been signaling a case for higher, not lower terminal rates. Powell is laser focused on the labor market and service price inflation. And I think weakness in good prices is not going to stop the Fed from continuing to raise rates to combat inflation. But I want to review some of the variables that may cause the Fed to change course. They include inflation, employment, manufacturing, and credit. And while some of these factors may cause a shift, at the moment, the Fed, from our perspective, is going to continue to raise rates. As they said, they would do it through 2023 and maintain higher rates into 2024. They're saying one thing, but the futures market is saying something different. The Fed said the terminal rate would go to 5.1%. The futures market doesn't necessarily believe that, a bit lower than 5.1%. And the markets are pricing 50 basis points of additional hikes by the second quarter of next year, followed by cuts in the second half. So there's some conflicting data of what the market is actually saying versus what the Fed is actually doing as well. So last week we saw the CPI print. It was high, but better than expected. But the Fed did what we thought they would do. They increased the Fed funds rate by 50 basis points. So it's 4.25 to 4.5. And their hawkish statements took the wind out of the market sail, dashing hopes of a pivot. But again, the futures market is saying something different than the Fed is saying. If you look at employment, the employment data, it's pretty strong. We have a strong U.S. labor market. And that is another component that the Fed has to deal with. We're starting to see some signs of moderation in the labor market. Wage growth in hospitality and leisure and food services, retail, manufacturing started to slow from peak levels, potentially reducing some of the inflationary pressures. And an improved balance between labor supply and demand could lead to slower wage growth, perhaps bolstering the case for a slower pace of rate hikes or a pivot. But again, I don't think the Fed is going to pivot in the very near term. But on a positive side, households are entering this economic slowdown with solid balance sheets, which is the consumer has been keeping up, helping support this economy. On the manufacturing side, overall manufacturing has demonstrated strength in 2022. This is building on the momentum it gained from the pandemic and surpassing expectations from the prior 2 years. Overall demand and production capacity have hit recent highs, but there's some indications that the near-term outlook may not be as bright. During November, U.S. export orders fell at the fastest pace since the pandemic. This reflected reduced demand both domestically as well as internationally or globally. Manufacturers have cut jobs. This is for the second month in a row. This is because capacity utilization dwindled and backlogs have contracted. And business confidence remained historically subdued as concerns about inflation and customer hesitancy weighed on optimism. So these factors led companies to reduce inventories through lower prices. Now, a contraction in manufacturing could cause a pause in Fed hikes, buying some time to assess some of the incoming data. But again, I think the Fed will likely remain committed to the path of rate hikes while buying time to assess incoming data. And then there's credit and the consumer. A rise in credit spreads, defaults, and tighter lending conditions could cause the Fed to pivot to avoid any sort of instability in markets. But that is not where we are now. Looking to the consumer, in the pandemic, the consumer had a lot of extra savings, but we've seen the personal savings rate drop pretty dramatically, actually, to 2.3%. This is the lowest level since 2005 and substantially below average savings rates from the last decade. But the consumer balance sheet looks pretty good, and it does appear that the consumer may be positioned to withstand some of this economic weakness that we're expecting. But deteriorating credit conditions could amplify recessionary risks over the coming months. And also, on a positive note, banks never expanded credit, so they're certainly not going to do it now. And U.S. banks are tightening some of their lending standards, which could reduce loan growth. During the Q3 earnings season, several banks reported less favorable economic outlooks and set aside more money for loan loss reserves. But banks are in pretty good conditions, or very good conditions, going into this downturn. So where we stand now, we have, we had a rally in stocks. Then we had recent pullback in stocks. We had a falling treasury yields, and the treasury yields have gone up a bit. But all of this really has loosened financial conditions, which could be another reason the Fed potentially could pivot. But the rally is fizzling right now, as we have seen over the past few trading days. Overall, we do expect a shallow recession next year, and that goes into how are we going to be positioned next year.
Right. That was an excellent summary of factors that are likely to impact the markets next year. And I agree with you. It's going to be all about the Fed, whether they'll be able to engineer a soft or softish landing in 2023. So with that backdrop, how should investors position their portfolios for 2023? And I believe that you help manage the model portfolios at Global X as well. So what are you telling your clients what they should be thinking about when positioning their portfolios for what's to come in 2023?
Thanks, Nina. And yeah, I manage the firm's model portfolio business, and we have 13 model portfolios. We have asset allocation models, which include stock, bonds, and cash. We have a thematic model or several thematic models. We have an equity income model. So those are single asset portfolios that we suggest clients use in a broader portfolio context, in which we actually use in our broader portfolio context. But in terms of overall positioning, first of all, I think a recession is almost a certainty, and the market is pricing in as such. And there's leading economic indicators that are already in recessionary territory, led by declining in housing and manufacturing. GDP forecasts across the street have come down, but not quite yet in recessionary territories, as indicated by some of the statements by Fed Chair Jay Powell. But this is a challenging macro backdrop. And it forces investors to balance near-term volatility with long-term opportunities. So in the near term, we do expect a bumpy ride for markets, but we're also looking for smarter ways to invest in growth. And there are a couple ways of approaching that. We're looking at growth companies with some of the same characteristics we're looking for in value companies. So we favor quality companies with strong cash flows. So the risk of a deeper economic contraction, lower liquidity, and declining earnings growth are all factors that could limit a meaningful recovery in risk assets. So we are looking for these quality companies, and those quality companies can come in the form of a growth company or a value company. And while the consumer is healthy right now, we do think that the consumer will deteriorate with inflation elevated, and there is some weakness in the job market that is starting to show. So these conditions favor defensive sectors such as healthcare, always a good sector in this type of environment. Consumer staples, people still have to buy those basic staples, and utilities. Consumer discretionary certainly is an area that could be negatively impacted in this type of environment. Globally, a peak in the US dollar could create attractive opportunities in China. China's a focus due to its gradual reopening from COVID to COVID lockdowns, which could spur economic growth in 2023. In Europe, energy reserves are high, which could boost sentiment. So I think that's an area to look at. Also, declining asset correlation could reinforce bonds as a volatility hedge in a balanced portfolio. So the outlook for longer duration products could improve as central banks slow their trajectory for rate hikes. We do expect fixed income to remain challenged in the first part of 2023 as policy rates rise to the terminal rate. But even in the slower economy, we're in uncharted territories in terms of technologies. Business models that are being disrupted. We're seeing disrupted in a positive way or more in a disruptive growth area. Shifting consumer behaviors are changing the way business operate, and they have to how business models have to adapt. And just in general, how we're transforming how we interact with our physical environment. And this year's pullback in growth equities, we believe, is an opportunity for long-term investors, especially as inflation begins to decline and the pace of rate hikes slow, and eventually the Fed begins to pivot.
Now let's talk about thematic investing and your favorite themes for 2023, because we know that Global X is a leader in thematic ETF investing. And I saw your recent note, and that lays out some of your favorite themes for 2023, including cybersecurity, clean energy, lithium, and US infrastructure. So maybe let's go through these themes one by one. Let's start with cybersecurity. And we know that cybersecurity, the demand for cybersecurity products and services has been rising because the risk of security breaches and threats continues to rise. And because of this economic uncertainty, many companies are cutting back discretionary spending, but cybersecurity spending is an area that they cannot afford to ignore. So that spending will continue to go up. So tell us about your thoughts on cybersecurity, why it could do well next year.
On cybersecurity, I think this is an area that makes a lot of sense for investors. Spending will continue in this area. You're seeing increased M&A activity. You're also seeing a lot of increase in cyber attacks, 28% year over year, and that's not going to abate anytime soon. Now, the cybersecurity industry has been through a period of consolidation. Both public and private companies are seeking to complete their all-inclusive cybersecurity solutions or suites of services through M&A activity. So the M&A activity certainly increases the interest in the area. And you're also seeing top-line revenue growth for cybersecurity companies. It's a great business model because it's a recurring revenue business model, and investors love that type of business model. So from all of those perspectives, from the M&A activity, from the need to protect data, cybersecurity spending just can't go down. It just has to increase, even if other areas for a company have spending has to increase. This is not an area that you can cut expenses.
Right. Let's talk about clean energy now. These stocks and ETFs got a big boost from the Inflation Reduction Act, which is the biggest spending deal on climate ever. So tell us what lies ahead for these stocks. These stocks are usually a little bit volatile. So why do you expect these stocks to do well next year?
We always say follow the tailwinds. And the Inflation Reduction Act, as you mentioned, will direct about $370 billion towards climate change mitigation. You're going to see the accelerated adoption of clean tech and renewable energy because it's essential as the world moves forward and looks towards net zero emissions. Now, you look at certain commodities like lithium. Lithium is the element that's used for batteries that power electric vehicles, as well as other areas like solar. And there's a shortage of lithium globally. And as you see an increase in electric vehicle sales, both in the US as well as globally, and the US actually has fairly low penetration for electric vehicles, but certainly is increasing. The need for lithium is going to only increase. So lithium is a very important component kind of in the clean energy space. And going back to the Inflation Reduction Act for one moment, you're seeing that over the next 10 years, you're going to see a tremendous amount of spending in this area. Then alongside that public spending, you're going to see a lot of private spending that goes along with that public spending. So because of that, and because of the need to reduce carbon emissions over time, in the near term, actually, spending in this area is going to only increase. Investment in this area is going to only increase. So clean energy, but solar, wind, electric vehicles, and all the ecosystems, or the ecosystem around electric vehicles, you're going to see a boost. And we think this is an area that is very important. And while we can't predict returns in the near term, over the long term, over the 3, 5, 10 years, it's just indisputable that this area is going to only accelerate.
Right. Clean energy and lithium are very interesting areas, and longer term outlook looks really good. Now let's talk about U.S. infrastructure. These infrastructure got a boost from the bipartisan infrastructure bill from 2021. And now that we have a divided Congress, this is one area which the two parties, I would say one of the very few areas that the two parties agree on, that is increasing spending on U.S. infrastructure. Tell us more about this.
First of all, I totally agree with you in terms of both sides of the aisle have a hard time agreeing on a lot. But I think what most agree is that the U.S. needs to improve its infrastructure, roads, bridges, tunnels. But the thing is, the packages have already been passed, and U.S. infrastructure continues to be resilient. you have this spending that's going to go on over the next 10 years. There's many projects that are just not shovel ready. So a lot of the spending actually has not even occurred yet. So it could take 1, 2, 3 years before a project is ready. Think how long it takes to plan a bridge or tunnel and all of the environmental studies that go along with having to build these different projects and all the different interests that go into saying, we don't want it, this tunnel here or this bridge here, it's going to impact different ecosystems. But the thing is, the bill has been passed, so the spending is going to occur. And then, like I mentioned earlier, with respect to some of the private spending that goes along with some of the public spending, that you're also going to see that in the infrastructure space. So private sector investment may be really well positioned to help any shortfalls in some of these infrastructure packages. So industrials and materials type companies certainly can benefit over the long run. So I think U.S. infrastructure is an area that should be included as a portion of an overall portfolio, and we're very bullish on this area.
Excellent. Now let's take a step back, and I wanted to talk about thematic ETFs in 2022. Now, the year was brutal for thematic ETFs. Many thematic ETFs suffered huge losses, but we saw that many investors stuck around. We didn't see heavy outflows out of these thematic ETFs. So tell us about the trends that you saw in terms of asset inflows and outflows in thematic ETFs in 2022.
Sure. So I want to step back for 1 second and talk about some of the flows into ETFs. And I think that kind of tells the story. So ETFs have seen strong flows for the past decade. Certainly, they saw strong flows in 2022. You also saw a good amount of outflows, significant outflows in mutual funds. So there has been a inertia towards ETFs in general. Investor preferences have evolved permanently from my perspective, which is really evidenced by the growth of the equity ETF, $7 trillion in assets since 2000. Obviously, with ETFs, you have lower transaction costs. This trend has continued both in bull and bear markets. When you're looking at some of the top performing sectors in terms of fund flows for this year, you saw surprisingly in tech, healthcare, financials, consumer discretionary, and consumer staples. And most of the tech inflows went into companies that were more high quality focused, which makes sense in terms of what I was talking about earlier, how we are positioned going forward. When analyzing fund flows by size and style, large cap ETFs certainly dominated the net flows. It was followed by dividend funds, value funds, and growth funds. And then there's large cap ETFs and dividend ETFs had the highest net flows relative to all of the flows. But value ETFs in terms of returns did the best. You also saw a tremendous amount of inflows into fixed income. Long-term government bonds had their best year ever. Short-term government bonds also had extremely high flows. This was, to me, indicating investors had the appetite for lower risk in an uncertain economic environment, of course. That increased the popularity of fixed income ETFs this year. And then, moving on to your question, the global thematic landscape has really seen impressive flows on a year-to-date basis. Some of the inflows came into the natural resources area, which we include as disruptive themes like uranium and disruptive materials, ag tech, autonomous vehicles, cybersecurity, clean energy, and cloud computing. We also inflows into these areas. And from our perspective, that's because investors are taking a longer-term view of these areas. They're disruptive, whether it be technologies or disruptive materials, that are going to play a big part in our future. So we think that investors are taking a longer-term view. Short-term, yes. From a return perspective, this was a very, very difficult year. But technology moves on, and many of these areas are going to play a part in our future. So that's why, from my perspective, investors are a little more forward-looking, which is positive.
Right. Very interesting and very impressive trends. Always a pleasure to have you on the show. And thanks as always for sharing your insights.
Thanks, Nina. I appreciate it. And Happy New Year.
Happy New Year to you as well. So that was John Mayer from Global X ETFs. Now let's talk about some thematic ETFs that you could use to implement those strategies that we discussed in the interview. So let's start with cybersecurity. Global X offers the Global X Cybersecurity ETF with the ticker symbol BUG. Other ETFs that you could look at, this one by First Trust, which is the most popular in the space. It is the First Trust NASDAQ Cybersecurity ETF. Ticker symbol is CIBR, CIBR. This has an expense ratio of 60 basis points. BUG charge is 50 basis points. And the best performing ETF year to date in this space is by iShares. It is the iShares Cybersecurity and Tech ETF, ticker symbol IHAK. This has an expense ratio of 47 basis points. And in full disclosure, I own this ETF in the ETF investor portfolio that I manage. Now, if you want to look at clean energy ETFs, Global X offers the Global X Renewable Energy Producers ETF. Ticker symbol is RNRG. The other two ETFs, which are quite popular with investors and have done quite well this year, in fact, despite challenging market conditions, are the iShares Global Clean Energy ETF, ticker symbol ICLN, and the SPDR S&P Clean Energy ETF, the ticker symbol is CNRG. So if you look at the expense ratios, ICLN has an expense ratio of 40 basis points. CNRG charges 45 basis points, and RNRG has an expense ratio of 65 basis points. Now, if you want to invest in lithium, the best ETF is by Global X, and it is the only, I would say, pure play lithium ETF. The ticker symbol is LIT. It tracks a market cap weighted index of companies that are involved in global mining and exploration of lithium or in lithium battery production. This is a very interesting ETF. Now, if you want to look at infrastructure ETFs, the one by Global X is PAVE, PAVE. It is the US Infrastructure Development ETF. And there's another by iShares that is worth a look. It is the iShares US Infrastructure ETF, ticker symbol IFRA. So thanks for listening. This is, in fact, our last show of this year. I'll be back next year with more interesting guests and interviews. I wanted to wish you all a very happy holiday season and also a very prosperous and healthy new year 2023. And I wanted to thank you all again for listening. Special thanks to those who provided their valuable feedback that helped us improve our show. And I'd request again, if you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. And if you have any comments, questions, feedback, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.